Welcome to First and Only, SaaS News Digest featured on LinkedIn, where I cover news, events, and updates that are happening in SaaS community worldwide. This week may be the beginning of the new chapter in the 2020 tech market story. The announcements of the vaccine for COVID-19 that is 90% effective has upended the stock market. We're now seeing the inversion of the price stock market trends. For example, tech shares were soaring over the summer, but now it appears some of those investments are leaving. SaaS and other software stocks may see their multiples clipped. Zoom and Peloton have seen sharp drops this week, and both down 13%. Online retailers like Etsy and Wayfair are also seeing a double-digit drops, and even Amazon is down 2.3% in pre-market trading. And meanwhile, this reversal of events is favoring sectors that were punished by the pandemic. Airline and cruise company stocks, for example, are rising from the grave. And investors appear to be moving their cash into the wider set of investments. This may leave the tech industry with lower valuations for public companies. And late-stage startup investments for tech companies have been active this year. But if valuation drop, capital might tighten for those startups. Obviously, it is too early to say for sure, so investors could be trading too aggressively over the news that is not really reality yet. It may take months to see the true impact of the vaccine development on the market shares. Our next digest today takes a look at the growing popularity of business-to-business marketplaces. Those are the venues for buyers and sellers of the business-related products. The need to conduct business online is a reality that is not going to go away. And combined with better infrastructure, payment systems, and security, marketplaces are exploding in popularity. B2B marketplaces were projected to generate $3.6 trillion in sales by 2024. And that was before the global pandemic struck. As developers rise to meet the growing demand of those platforms, innovations may play a key role. Marketplaces need to be more than just stagnant platforms for business transactions. Solutions need to include additional services and offerings to gain traction and momentum. But B2B marketplaces cannot play by the same rules as B2C platforms. As one expert points out, a consumer buying one bag of candy looks nothing like a retailer buying 100,000 bags of candy from a distributor. But there's many ways to extract value that could go beyond traditional B2C methods. The first method is to consider involves sampling fees. A fees per sample model is the great way to aggregate suppliers and buyers who want to sample suppliers before placing a huge orders. This method works for construction materials, interior design, maybe chemicals, apparel, packaging, and more. By charging manufacturers a small fee for very sample shipped out, they receive new customer leads. Another angle for B2B marketplaces to consider is the monetization of data. And many B2B verticals do not have a clear idea of what their perceived market share is or how their product will perform against the competitors. But B2B marketplaces have an opportunity to change that. Insights from transactions, activity, and data collected on the platform can be monetized. Another marketplace option to consider is the inclusion of embedded financial services. This can be in the form of integrated payments, lending services, and insurance. B2B marketplaces are in a great position to offer all three. In addition, marketplaces can offer targeted advertising, private label products, and charge subscription fees. And as you can see, the possibilities of innovation with B2B marketplaces are almost endless. And the larger suite of the offering, the greater potential to become the next billion-dollar business. Our next digest today takes a look at the rising popularity of bootstrapping, my favorite. More and more startups choose not to raise funding. Instead, they begin with limited resources and no outside capital. And the first argument in favor of this is that the market validation is more valuable than VC validation. Venture capital can support an idea, but market might not agree with that. The second issue at play with bootstrapping has to do with equity. Well, VC requires equity often up to 20 or even 30% of the business in a seed round. With bootstrapping, founders retain that equity and control of the business decisions. For example, Mailchimp is a company who never raised funding and always bootstrapped. The CEO says that the potential investors always wanted them to cater to enterprise customers. But Mailchimp stayed true to their vision, bootstrap, and now their annual revenue at $700 million. The next reality at play with bootstrapping is an amazing ability of a cheap or free tools. In the year of 2000, it cost around $5 million to launch a company. Now, thanks to the open source software and cloud-based tools, it costs less than $5,000. Also, worth to considering is the fact that the time spending fundraising is the time you're not closing sales. And bootstrapping trains startups to be lean from the start. And startups with a lot of money have a tendency to spend it on the things they don't really need. And since many businesses model change in the first few years, it can be smart to wait until the path is a little bit more clear before looking for extra cash. Those are just a few things to consider before you seek funding for your next startup idea. I hope you enjoy SaaS News Digest. The SaaS News Digest belongs to all of us and provides the value to the members of our community simply because of you. So please click on like or insightful button, share the SaaS Digest on your LinkedIn page, and let's work together in developing this community and setting new SaaS global standards. My name is Artem Gassan. I'm the general partner at SaaS Growth Ventures, and my superpower, I fuel growth and revenue for SaaS companies. Thank you for watching, and I'll see you next time.